Okay, Jenny Turner, Lovejoy Real Estate, and I'm here with Stephen Bowdon at Guild, and we're just talking about what rates have been doing this week. So tell me a little bit. I know they've been volatile. I know it's been a little bit crazy, but what are you seeing out there right now?
Yeah, so we saw rates come down a little bit because we had kind of a resolution in Iran, and inflation is a big word when it comes to mortgage rates. And when inflation goes up, mortgage rates go up. When inflation goes down, mortgage rates come down. So the reactivation of the conflict in Iran is, the cost of oil, it essentially is everything, right? Like transportation of goods. I mean, literally everything we have has to do with oil. So that specifically has rates kind of ticked up. And we're in that mid to upper 6 range.
So still in the 6s?
Yeah, still in the 6s. We've kind of still been in the 6s all year. Low 6s versus high 6s, and depending on your loan amount, sometimes it might be only $75 a month to your payment difference. Mm-hmm. So I always say don't freak out, just make sure you're running payment scenarios by people to make sure that whatever that knee-jerk reaction was, how that impacted you on your monthly payment. Sometimes it might only be $50, $75.
I know I'm definitely encouraging my buyers before we make an offer, before honestly we even go look at houses, that they run the house and the payment scenario by the lender so they understand exactly what it is, right? Because taxes can make a difference, interest rates can make a difference, all those things really matter.
Yep, 100%. So I think the number one mistake that people make when they're buying a house is they get an approval and they just go look at houses. It's like a blanket, I can approve up to $700,000, I'm only looking $500,000 houses, and they just run amok. Mm-hmm. And then they're like, and then they get into contract and then they go, I didn't realize I had an HOA, or I didn't realize those taxes were so high, or I didn't realize interest rates changed. And I'm like, well, it's because you didn't run it by me. So a lot of times I always say, before you even look at the house, send it to me first so that you know from a bird's eye view, what does that kind of look like? And then we fine tune it later. We sharpen the pencil later. I mean, you're going to negotiate, go higher or lower or closing cost, whatever. But knowing what the payment is before you see the house is probably the biggest thing. Because then you don't have to worry about what's going on in the media, and you don't have to keep up with it. You're getting a live scenario that day based on whatever's happening.
On that house.
On that specific house. And you don't have to worry about it.
Does it annoy you if a buyer is going to go look at 5 houses and they send you 5 houses to run scenarios on?
No, I honestly prefer running the scenarios, because what happens is if they don't, then they get into contract, they run the scenario, and then freak out. And nobody likes to freak out. So I'd rather run multiple scenarios for people so we don't have the freak out moment. It makes my job actually easier than spending a couple hours trying to calm somebody down after getting a contract than 10 minutes running scenarios.
Well, and we talk about this a lot, that we don't, I don't care what a buyer is qualified for. I care that their payment is in their budget, right? That whatever they want to be. So if their budget is $4,000 a month, $5,000, $40,000, whatever it is, that the house actually fits in their budget. Mm-hmm. Much more than could they qualify? Do they qualify?
Absolutely. Yeah. There's what you are comfortable with paying, mm-hmm. what I call your comfort zone, and then there's what you qualify for. And those are normally, depends on who it is.
Right.
Some people are willing to spend their entire paycheck on that because they don't leave the house, they don't want to go on vacations, they don't do it. So it is a quality of life thing.
Yep.
But 100%, just because you can doesn't mean you should.
So what's going on with the new Fed chair? Because I know originally there was some talk about maybe that would have rates come down, but now maybe not. So what is he doing?
Yeah, so the new Fed chair, they did this thing called quantitative easing and quantitative tightening. And that sounds really ridiculous. But what happened during COVID is the government was buying mortgage-backed securities as an investor. What that did
artificially
bring rates down. So they basically injected themselves as an investor, a separate investor, and said, we're going to buy trillions of dollars worth of mortgage-backed securities. And when you do that, it drops rates down. Well, guess what? We have to sell those at some point. It's like buying a stock.
Yeah.
We can't hold all that stock. So they had to sell it. The new Fed chair will never, as long as he's Fed chair, buy mortgage-backed securities.
Oh, he said that.
He will never buy mortgage-backed securities. He is only going to sell them to get them off our books. We are, and it's not a debt; it's an asset. So, but in order to use that money, so what they'll do is they'll sell those, and then the government can invest that money that they had invested in mortgage-backed securities into something else.
So if we buy mortgage-backed securities and that lowers rates, if we sell mortgage-backed securities, does it raise rates?
It can raise the rates depending on what speed they do it. And so that's part of the problem we had the last couple of years is they had to offload. They bought too many. Mm-hmm. And so they had to and we did it for too long during COVID. They should have stopped it a year sooner. And so they have to get those off the books so they can reinvest that money somewhere else. And so when they do that, if it's a combination of that and like a new Iran conflict, then rates kind of start to tick up.
Right.
And so the Fed and the Treasury they can kind of control how much they're dumping into the market. But they have to get it out there. So sometimes it just is what it is because they have to get it off their books. It's not a debt. And I think a lot of people think that them having that is a debt, but it's not. But they still need to get it off their books. So they're getting it off their books almost like they have to get it off their books. Hopefully there's going to be less noise in between things with the new Fed chair. He's trying to keep a little bit tighter leash from all these other people that are part of the Fed, like yakking around all the time, causing this in-between meetings volatility. So I think in the long run, it's good because it's like let the market do what the market wants to do,
right,
and don't meddle in the middle of it. So I think long term it'll be good, but right now, I mean, I would love to have them buy some mortgage-backed securities to get us some better rates. But in the long term, I think it'll be good. But in the short term, rates are going to be a little bit higher.
Okay, so I bought a fourplex this last summer, so almost a year ago now.
Yep.
And I have been waiting very impatiently to refinance, and obviously we're not there. I know that we're not there yet.
Yeah.
But crystal ball, what does that look like? Like, when do you think we'll be back at that, like, 6.599, 6, give or take, plus or minus?
So inflation is kind of a weird thing, right? So, like, we went from $120 a barrel down to $70 a barrel for oil, and now we're back up again.
Okay.
What happens, and then you've got oil production and then oil transportation. So let's just imagine the conflict in Iran ends tomorrow. It can still take some time for the production to get back to where it was, for the transportation to get back where it was. And just like we had that fake out a month ago, oh no, hey, everything's great, right? We're right back to where we were. So that does take quite a bit of time.
And I feel like rates go up really fast, but then slowly
go down. Up fast, knee-jerk reactions, down slow.
Yeah.
And so it could be months. I mean, I would say next year. I mean, absolutely next year. I don't see
2027.
Yeah.
Yeah.
And that's if everything aligns, right? Because we're going to still be getting these mortgage-backed securities off the federal books. And we still have this random inflation issue with Iran and oil and all that stuff. I mean, eventually that will sort itself out. But I think we're in a longer road. I think the expectation was for this year, we were already tickling the 5% rates.
No, I remember, like, it hit it for like 28 seconds.
In February.
Yeah.
And so we were getting there, and the economy is going in the right direction. So inflation is down with the exception of what's being caused specifically by oil. Yeah. We were heading in such a good direction. And so once we get the oil factor out of there, we should get back to where we were on pace this last January, February. I think we were all expecting rates in like the mid fives this year, and I just don't even see hitting fives at all this year. I think we're going to be socked into the 6% ranges.
Because it's already August, and we're at 6.75, give or take, right? So that's a long ways to get down.
Yep. So that's we're kind of in there. But I mean, big picture, we were at 8. We were at 8 2 years ago.
Yep.
And guess you can still do 2-1 buydowns. So
talk to me about that for a second. Like, I know you like a 2-1 buy down better than a permanent buy down.
Yeah.
But I don't think people really understand the difference. So can you walk us through that?
Yeah. So you have a 2-1 buy down, which is a temporary buy down, which is different. So like when most people don't even understand that because it didn't come out until this post COVID. And so a permanent buy down is where you take your rate from 6.75 to, let's just make it easy, 6.5, and you pay a fee at closing and you buy your rate down permanently.
To 6.5.
Yep, permanently. So for the life of that 30 years.
Is that fee called a discount point?
It's a discount point, origination fee. There's a lot of different words that people call them. So that's permanent. So what you do is you have to look at your break-even time on something like that. So 0.25% on an average loan might save you $50 a month. Well, what if it costs you $5,000? It might take you 3-4 years to break even on that. What a temporary buy down does, let's imagine, let's go back on that. Let's say it has a 3 or 4 year break even, and you haven't broken even, but rates get better. So you were free at refinance on year 2. You spent $5,000, your break even time is 4 years, but you can refinance in 2. Well, you're going to refinance in 2. Well, guess what? You kind of wasted your money buying your rate down. And they don't give you a refund.
Yep.
Banks make a ton of money like having people buy their rates down that never even hit the maturity of that, right? So what a 2-1 buy down is a temporary buy down where the seller has to pay for it. And let's call it a 2-1 buy down. So if your rate is 6.5 today, it's 4.5% for the first year.
2 full percent.
2 full percent. So it's a 2-1. So the first year you're 2% lower than today's going rate. So if it's 6.5 today, you're going to be at 4.5 the first year, 5.5 the second, and then it matures at the 6.5. If you refinance, and this is the big thing that I'm a big advocate for, if you refinance in 12 months, any of the money that was used to buy that rate down for the 2-1 that's still left in that pool that's supplementing that payment gets refunded back to the borrower and used towards their cost of refinance. So you don't lose it. So it doesn't matter.
Yeah, right. You don't lose it like the
There's no break-even time. Well, one, the seller's paying it. Two,
well, Yes, but the seller paying it really is the buyer paying
yes,
it. And
yes,
just financing it in. So
that's true. That's true.
Realtor, lender, like difference, but yes.
But I mean, think about that. You spend 4-year break-even time on a permanent.
No, totally.
Doesn't matter what your break-even time.
Yep.
I always tell them it could be 6 months, and guess what? You're going to get a $10,000 credit to use towards your refinance, permanent refinance.
Right.
And so I don't think anybody's going into their mortgage right now thinking I'm going to have this loan for a really long time.
No, nobody is.
And so explaining that to clients, I just had a client do a 2-1 recently. They just closed last month, and they were hesitating even to buying the house because they were wanting to wait for rates to drop. Well, they had a house. The house they really liked had been on the market quite a bit of time. The seller was willing to move for them. And I'm like, why don't you do this? And they're like, well, what's the catch? And they were stopping themselves because they didn't want to do a permanent buy down.
They understood
like,
that.
I don't want to make that initial huge investment because it's a waste of money right now because we know rates are going to come down. I'm like, no, that's not how this works.
Yeah.
And then explain that. They were like, what? And so it does work in the right situation. But again, that one is the seller has to pay it. If it's super competitive offer, those don't typically happen. So,
right. Just depends on how you can make it work. Okay. Excellent. Okay.
Yeah, cool.
Thanks so much. I really appreciate it.
Thanks
Jenny Turner, Lovejoy Real Estate, Stephen Bowdon with Guild. If you've liked this content, please remember to like, subscribe, hit the notification bell. It really helps our channel grow.